live. Scott Boyer is in the house from Done For You Homes. What's up, Scotty?
Howdy, man.
Good to see you, my friend.
Good to see you.
Okay, so lots of discussions about passive investing in real estate, investment in real estate. Are we at the top of a market? We've had some big economists come out and say 2020 recession, which makes sense to me. I'm not too hip on all the economics bow tie guy stuff, but we do know that auto loan defaults are up, mortgage defaults are up, student loan defaults are up, and credit card defaults are all up. So there's this thought that we're at the end of a short-term credit cycle. We have a presidential election in 2020. So people are saying, hey, this might be the last good market to sell your real estate in. But for investors, for investors, a lot of times they get stuck in that spot. Like, well, I would love to sell it.
It happens all the time.
But what am I going to buy? How am I going to replace it? Because I've either got to take a huge capital gain tax, or I have to 1031 this thing into something else.
Right, and sometimes it's something else that they don't know what to actually do. So but it is almost a little bit of that deer in headlights where you get to that place. I mean, let's go back for what everyone knows. You go back to 07. How many people looking back would said, man, that would have been the time to get out. But okay, so the question is then why didn't you?
Even 06.
Sure, and it's because you think there's a little bit more, and you want a little bit more, and then also you're like, okay, but even what do I do? So there's also is that, especially in the investment community, that can be a little bit harder as far as of what to do with that. In real estate, there are avenues that are there. So, and again, it all kind of went south in 08. So whether you're in real estate or whatever the case might be, everyone kind of felt and has that experience or knows people. And that's the thing, is that at what point do you say, okay, the market's been up for basically 10, 11 years, okay? So with that kind of a run, and real estate doing that kind of run, at what point do you lock in that and make a good move and protect yourself against a downturn? Now, you might leave a little bit on the table, but that's better than having another experience of looking back and saying, why didn't I, how did this happen? And that's the part where it takes an investor that just has, I think, the fortitude and also looking forward and setting themselves up long term.
I think it's really just wisdom. I mean, if you look at, some of the best advice I got, one of the smartest and wealthiest guys that I know, he sold his company for $31 million, okay? The following year, that company was doing double the revenue, would have been worth twice as much, but on the heels of the stuff that he had set up. And I knew that it bothered him. When I asked him about it, he said, hey, I would rather sell too early than too late. So it's just that, and that is stuck in my head. I'm like, you know what?
That is that's always the hard part where, again, people always think there's a little bit more, and they think, well, I'm not maybe sophisticated, or if I don't get out right at the top. It's like that part rarely happens unless like you're in Vegas and it's just luck, and luck will always tend to what?
Even itself out.
or just run out.
Or just run out, or go the other way.
Right.
But so let's say, what about even an investor who realizes and wants to get out, but looks at it and goes, well, where am I going to put it? I mean, I've got $1 million worth here. I've got a 2-unit, or I've got 4 houses, and where am I going to? If I sell, I've got 90 days, right, on the 1031.
Yeah, you've got to. Yeah, it goes into an intermediary, and you've got to identify properties, and there's a lot of details in there. But it's just a process. You've got to hit the P's and Q's. But
so they feel like they're just trading one for another.
Right.
But there's a lot of people who have a tremendous amount of profit. And for me, I just hate to see them lose that, or I hate to see that go away. The one thing about equity in real estate is that, it can go up and it can go down very quickly. But it goes down a lot faster, it seems like, than it goes up.
Always takes the stairs up, and I don't know if it's
the elevator down
or the cliff. I mean, it just
it's like I hate to see people lose money, but a lot of people have bought homes and they were doing so well on those homes. The values were up and they were able to rent them, that when they bought their next house, they kept that one as an investment. So even that person who thinks that, well, I just have one house, it was worth $650,000, and it's in a nice neighborhood, and that's great, and you get $3 grand a month in rent, and you feel like you're killing it. But what is the alternative? And that's where Done For You Homes comes in.
Right, and we've done a really great job, and we picked the right markets. And I would say that there's just an article that just came out. There are 40 markets that I would say don't go into, because all the numbers are looking that there's something coming up even like this year that it's not. Those are not good markets.
So we're going to actually share with you all 40 of those markets before the end of this video, so that you can see exactly where you definitely want to, I think, avoid investing in real estate here in the next couple of years.
Yeah, but where we've done it in Indianapolis, that's where we've really, it was a good choice when we started this 10 years ago. And my partner, Michael Drew, we had him on last time and talked about, you know, a lot of the history and how we started. But it's been a great market because, you know, I get investors that will say, okay, so if I'm going to 1031, so I guess the house is there, what, you know, 150, 250? Like, no, actually, where we're at, we're in that B marketplace, and you're talking 80 to 90. And it's the what?
Yeah.
And they start
doing
the math, right?
A single family home, not a condo,
right?
But a house,
right? And so when we start penciling out numbers, is that you're talking, you know, on the net cap, you're talking 9–10%. I think the larger the portfolio goes, if you're taking out 10 houses, you're probably going to be a solid 9.
But also, we should mention that those homes at 80 or 90 or whatever, that's post-rehab.
That's post-rehab.
Not pre-rehab. So you're not buying a piece of crap.
No.
And then renting it out to college kids and letting them destroy the place.
Right, and that's one of the keys, is that you have to have a certain clientele, as far as that if you don't stay in certain neighborhoods, yeah, you can get a cheaper property, but you're going to get a clientele that is going to be much more transient and is not the kind that is our bread and butter. It's the working class. It's either the retirees that they're looking for that one last place, and they're just renters, and they're going to be solid, or someone that is working class and they're not someone, because there is always that place. Like when you get into sometimes duplexes and in smaller places, that your rents are going to be, you know, $650, $675. You get a certain clientele, because look at the rent, and that's just not the clientele that long term you're going to really want. You have more turns, you have more deferred maintenance, and that all goes into the numbers. So part of the formula, in the sense of what we do and having it done for you, is truly you buy them right in the right neighborhoods, and we know that town really well. So you buy them right, get them rehabbed, and get the renter in, so they're already under management by the time the investor has it deeded to them. So it begins to cash flow. So for the passive investor that just says, I just don't want the headaches, then this becomes the process. And 1031s are a very normal conduit to actually get that done, whether it is just, I've got one home and I want to turn it into cash, but I don't want to have it here anymore, and I got all this capital gains and I don't want to be taxed on it, so what do I do? And this is what we do, whether it's one property, whether it's 10.
Yeah, and you can do that a number of different ways, whether you're a cash investor, financing, IRA, 401ks,
right,
which is really cool. So this is now. So let's talk about Indianapolis for a second, and I'll tease you with a few of these markets. Let's give them the first 5. How about that?
Sure. Yeah. We'll do the bottom. Was that 40 through 33?
Yeah. So Tulsa, Oklahoma. This is looking like, these are not as bad. So this takes you to the worst one. So this one's showing that percentage of mortgages in Tulsa underwater 10%, median home value 120. They give you, and this article is on gobankingrates.com, and it gives you a lot of information about, you know, what's going on with these different marketplaces. So
yeah,
Tulsa,
and all of these were cities that are worse than the national average, but on multiple points. But I think that the main one was the default rate, and I think what the average is, I think 8, and so all of these were worse than 8. So
yes,
that's where, and then it rolls down where you begin to see, wow, these get really bad. And here's the funny thing, is that a lot of, I would say, other players in our sandbox are in some of these other cities, and so that's what I get. I really, you know, want to shake an investor and say, whoa, you know, you can get the pitch as far as saying we have better cap rates. Well, yeah, I can get you. I mean, that's not the difficult part of the equation. It's if you're a long-term passive investor, it's not just the numbers by itself. You have to be in the right market. You have to be, or else you're going to have headaches that you never saw coming. and either it's going to be with the market, it's going to create a problem on getting out. And that's one of the biggest things, is that I always want to have an investor that if he needs out, he can get out.
And Indianapolis holds value well because of just sort of the economy, the structure there, the universities.
Right. It's a high rental market, so it holds well. It has for years, but it's also well diversified. So proven over time is that it's one of those cities that just has they run their books well in the state. So you have a state and a city that just has the underpinnings of all the things that you really want. It's landlord friendly. So it's not like California where you've got to evict somebody and it could be 6 months.
If that. That could be quick.
Right.
Well, I think that for people, I mean, just to kind of hit on essentially what we're asking here is, should you 1031 exchange out of California real estate right now? I mean,
yes.
Here's the thing. Yeah, I mean, I think it's
it's not
not
just, that hard.
It's just a matter of how long you want to gamble. I think you mentioned, where I got like a 10-year bull run on that, and we definitely do stock-wise. I know the low of the stock market was March of 2009.
Right, 666.
So that's 10. Yeah, right.
It was
the S&P 666.
Right.
So that's almost exactly 10 years ago, and the real estate market sort of started rebounding just shortly after that. So we are at that 10-year cycle.
Oh yeah, and the real cycles, if you get into that, that's a whole other conversation, but the real cycle in there is actually less than 10. So we're basically
7 to 10.
Right, yeah. So we're actually over the edge. We're over top of our skis of when it comes to how long that this runs. And we all know this, is that the longer and harder it runs up, what's that make? It makes the fall even harder and faster. And that's where people have that capitulation point where they finally decide to get out, and they've lost so much already that they just can't stand it anymore, and they get out at a really bad point. And that's where better to get out and transition into something that's a hard asset and is going to be great if the economy does pull, but in the right market, so you always have an exit. So if you're going to 1031 and take some of that money off the table, it's just do it right, because there are going to be things out there of like, hey, we can get you a 12, 13 cap rate. Yeah, and you'll have no exit, and you're going to have a real problem with probably vacancies, because if things start to go south in these cities, people just begin to leave en masse.
Or depreciation. I mean, that's always the big concern when you're buying real estate, is how much am I exposed for depreciation-wise? And I think that's one of the main reasons you guys chose Indianapolis. Is a very solid. You're not going to make $1 billion on the appreciation.
Sexy. It's not.
But that's not the point.
Right. Yeah. From a passive investing standpoint, and to put it into place to where you can sleep at night and know you can open up your smartphone and look at your bank account and see that the deposits are there. That's what you want. You want something that just performs. And so 700 doors in to this, and we're depositing $700,000 a month to our investors' accounts. So that's what you want.
And it should be known too that you actually own the home. So I mean,
it's deeded. Yeah, it's not. It's not a fractional or something. The property is deeded to the investor. We make our money on upfront on just the spread of buying it right. So that's what's in it for us. And then long term, because the smart thing is that if I give an investor a great experience and it's a solid property, and even if they start out with one or two, when they have that experience, then they'll come back for more. And that's smart for us, because then long term, it just creates that the vast majority, probably almost 60% of our business now, comes from our existing clients. But we always have a little bit more room and to grow thoughtfully. And so that's what we're looking to always do, is to do it in a methodical way, find the right investor, do right by them. And that's so key, is that if something ever goes wrong, just do the right thing.
And if you want to get the higher cap rates in the proven market of Indianapolis, Done For You Homes, a great place to do that. If you want to take some huge risks, here's some more cities.
Let's look at the other places that are.
Let's continue to check them out here. So Memphis, Tennessee, number 35.
That's a big one you hear about.
People are in Memphis big time.
Yeah,
there's no doubt.
It's on the edge. Miami.
That is just a ticking time bomb. I mean, that is.
But those are the markets that look great, but they really fall off hard.
Right. No, Miami's going to crater at a certain point here. Aurora, Illinois is also making the top 40 here. Michigan, a lot of people went to Michigan.
Oh yeah, Detroit's on the list. I'll say that, but it's a lot closer to the top.
Yeah, we're still down in the 30s here.
Right, yeah, right.
New Orleans was another big one. I mean, after Katrina, there was a ton of investors who got in there, and they've made a huge killing. And this is the point, like, even in California, people have done really well with their real estate investments, done really, really well. What I just don't want to see is I don't want to see smart investors who bought right miss the good exit opportunity. Because here's the other thing that's happening right now that a lot of investors may not realize, especially if you already have financed your investments, is that rates just dropped quite a bit,
right,
which has caused buyers to come out of the woodwork.
Right.
And we're seeing almost a frenzy again in the market, just like that. We have 6 months of kind of what's going on, and then all of a sudden, boom, here we go, and they're all here. So as a seller, that's why it makes sense. Not just the cyclical stuff, not just the fact that I got a big profit, not just the fact that I should really get myself out of a $500,000 rental property in the ghetto of San Diego into 5 different rental properties in a market where it's safer.
Right. Because if the windows opened up, I mean, think about the last 6 months. Even San Diego, everyone was kind of like, what's going on? And prices were beginning to flat and beginning to decline. So if rates are obviously a huge driver, and they've pulled back a little bit, it's a window. So if you saw it, kind of missed it the first time because you're like, oh, well, what's happening? And now this is the moment in time to where you have an opportunity to make the transition, because we probably already have an idea of what's going to happen next time, but will it be harder, longer, faster?
It's really hard to say.
I guess that's right. It's hard to say, but the risk of that long term is that it could be the start of the longer cycle that either you're stuck or you are going to take an absolute hit on what you could sell the property for and change it out, and even possibly even double up. If you're an investor, double up your cap rates from what you're experiencing in San Diego.
That's the other thing. It's not just about protecting the equity. It's also getting more cash flow. I mean, pretty much anyone who owns an investment property in California, especially in San Diego, you can get a higher cap rate with the done-for-you model.
All day long. I mean, that's so many of our investors obviously come out of California just because of they've kicked the can so long that they've tried multiple things and they're just at the end of saying, it just doesn't work here anymore. But I don't know how to get out of California. So they just keep trading like one property for another, but really not making any great improvement. And I hear that from the 1031 guys that it's really hard to have a portfolio to where of what they're going to put them in here, because you make an incremental improvement, but not the jump.
Yeah.
So to go from like a 5 to a 9, 10, all of a sudden for cash flow and what's in your pocket, that's significant.
Well, it's a total game changer, especially for people who want to get out, who want to stop working or
passive
retire.
Investor, the passive investor
like, hey.
that truly doesn't want to go tinker with it and is okay with it not being on the block behind them, where they can say, yeah, I can see my property and that makes me sleep well. Well, if you do it right, and if it's already done, truly done, and again, some of the players out there that we've seen, they really do it wrong, where they'll sell the property and the price will say, we'll rehab it after the fact. And to me, I would never do that, and I would never counsel anybody to do that, because if you're going to go out of state, you want to have all the boxes checked before you get involved. So if it passes inspection, bring another inspector in if you want. Have everything done so by when you get it, you know exactly what you're getting, and we put more into that rehab process on purpose. So we change out all the mechanicals and we do everything correctly. If it needs a new roof or it doesn't have a life cycle beyond a certain point, we're going to replace the roof. We're going to take out a water heater if it's more than probably 3 or 4 years old, and that's just so that you take care of that deferred maintenance cost, so that investor has a fantastic experience for a longer run in a neighborhood that has the ability for rents that are going to perpetuate longer. I think our average lease is 28 months. So we're talking about not just 1 year leases, but over 2 is the average of what we get a client to stay, and that's great for the investor. And that's the kind of product that you really should be in. And it doesn't have to be behind you, a block behind you. You can do it out of state, and 1031ing out of state is not that big a deal.
Yeah, let's say it doesn't make a difference,
No, yeah.
right? When you don't have to. I think some people may think that you have to 1031 inside the same state or even inside the same city, but you absolutely don't. 1031 is a national rule. It's a federal tax code.
Yeah, yeah. And actually, I'm hosting with Lance Growth. We're going to be up at I think it's the patio April 25th, and I'll take and make the invite that if you want to come out to that, you have to have a ticket, and this will be for investors that want to get more information and learn about the 1031 process. Obviously, it's a great thing to say wine, taxes, and investing. That's a great thing. I'm going to be there. Would love to meet and talk, and also you'll have a chance to meet Lance and his firm. They do this, and they are a 1031 exchange firm. So hit the link. I think it's on Eventbrite, I think.
Yep, and we'll post it.
Yeah, post it, and come on out and have a chat and go from there and see how this all works.
Let's save you from a few more cities here.
Oh yeah,
we got so many to get through here. So we're still in the top 30. So Miami Beach, also, Miami. We talked about that.
Oh, St. Louis. Yeah,
no,
I know. Yeah, I knew you were gonna that's
brutal. But at least it's down at 29. Okay, yeah. At least it's not, because these are getting worse, by the way. So the closer we get to number one,
being from the Midwest, and I'm a Buckeye, born, bred, raised, and I've got my own, towns in there that are taking a hit. So
Mobile, Alabama.
Yeah, exactly, and that's again, yeah. So and these are some of the ones that are supposed to be the hot little cities of where you go for out of state investing. And Mike, it's just a concern of, yes, the numbers look good, look great, but you're taking such a high risk that's not smart for a passive investor to be putting their money into these markets.
Joliet, Illinois, never heard of it.
Yeah, that's okay. Probably not missing much.
Syracuse, New York. I didn't realize that there was such a investment push in Syracuse until just recently. Had no idea. Median home value, and this is in New York State, 87 grand.
Yeah, you're upstate. You're not in Manhattan.
No, exactly. You're definitely not in Manhattan.
Oh wait, that's right. There's a whole other part of New York than just the city.
You're not in Manhattan anymore. Norfolk. That's how it's said, by the way. Norfolk, not Norfolk. Right. If you say that to someone in Virginia,
we know you're
not
from there.
Yeah. So that one, actually, they've got a lot of mortgages underwater there. That looks pretty scary.
Yeah, and it's just, when you look at some of these where they have double the rate of foreclosures and the amount of homes that are underwater, it's not hard to see why you want to avoid these places.
Chicago, I can tell you, I wouldn't invest there with your money.
No.
There's just no way. That place is nuts. It's a great, fun city. Spend a weekend there.
It's one of those places that's good to visit, but not live or to me or invest.
Yeah, definitely not investing. So another Virginia city. So the state of Virginia has got some issues here, as you can see. There's and multiple Illinois cities as well. So you can kind of get a feeling there.
So naturally, most people think investing, and they hear this, go back to the Midwest. That's a general statement. And that's in general, you could say that that's correct because of the numbers, but long term, you have to be very specific on where you go, and then also have someone that's boots on the ground to where that they actually know it to the point where they can get you into the right properties and neighborhoods.
Yeah, you got to make sure. There's Akron.
That's where I was born.
Come on, LeBron.
I know.
Make something happen.
What
are you doing?
He's out here now.
What are you doing?
That's right.
They benched him. Another Georgia city there too, and so you see the South. I hear a lot of people going to North Carolina, Oklahoma, blah blah blah. There's lots of these places where Ohio we mentioned. Here's Connecticut, that's an interesting one. Yeah. But as we get closer here, these are getting to the worse and worse ones. So like Toledo, Ohio. Look at this 25%.
But that's
mortgages underwater.
Is that number 13?
That's 13.
Right. And the numbers are just it's
skyrocketing.
Awful. Right.
This is crazy.
It's the cracks.
Birmingham, really?
Right. See, this is one of the ones I hear a lot about. Oh, I hear there's great numbers in Birmingham. Well, okay.
It's true.
Yeah. Right. There's also Ponzi schemes out there for you to put your money into, for investing. It's not going to work out well.
Columbia, South Carolina. I'm really, really surprised to see that one up here. But it just tells you it's the highest foreclosure rate in the study. Wow, the capital.
Yeah,
that's crazy, man. This is just this is kind of shocking, to be honest with you. I haven't looked at this until just now. Montgomery, Alabama.
Yeah, another Alabama. Yeah, but these are the places that I that I have to navigate around of what everyone says. Well, yeah, but what about this? And do you have places in you know, do you have any properties in these cities? And we're like, no, and we won't, just because Dayton is another one that people always hear these great numbers.
Yeah, I hear a lot of Ohio.
Yeah.
I hear a lot of Ohio. But look at this.
Our answer is just no.
Yikes. This is some really scary numbers here. So these are places you do not want to invest in real estate anytime soon, just based on the data.
Another North Carolina.
A lot of, you know, foreshadowing that's going on with the data here in these different areas. And this is on gobankingrates.com. We'll post this link in the comment section as well if you'd like to check it out yourself and kind of scroll through here and see. And then Cleveland.
Yeah.
Big one.
Yeah.
Lots of people in Cleveland.
Oh, yeah.
They didn't even put Cleveland, Ohio. They just put Cleveland because there is no other Cleveland.
Right. But the numbers are just, you know, you need to steer away from, but the initial numbers will always look good. And so there's, I hear about that being in 1031 proposals because of the numbers. And it just is like, no, you've got to think longer term. And a passive investor, you know, needs someone that knows a market well enough to where your money is going to be safe long term.
Yeah, because you could get like
long-term
100% cap rates in Detroit.
Right, right.
I mean, you were
on the block.
You could buy a house for $5,000 and rent it out for $500 a month. I mean, you're literally making like 120 on the cap rate.
Right.
But you had a little bit of risk.
Right. Now, on the next downturn, they're going to just bulldoze your whole block.
Yeah.
Like they have.
You
before.
may not really own it in Baltimore. That doesn't surprise me. That one seemed to be coming on too strong.
Was that 4?
That's number 4.
Okay, 4. Back
Connecticut again.
Yeah.
So Connecticut taking a bath in this study, big time. Cleveland had the second highest foreclosure rate.
There's another big one you hear about is Detroit.
Yep, which that we were just talking about. Yeah, that's
obvious, but
it's just the wrong time. You know, 10 years ago, you know, when Detroit was dying, like that would have been the time to invest because you buy a house for $1,000 and you didn't really have.
Still, the problem is you have it so heavy to one industry, obviously, and there become the risk is that
long term
everything is predicated on how well the auto industry does, and if it's not going well, it's going to have a mass exodus once again.
Avoid Newark, New Jersey, folks. That one is number 1 on the list.
Well, who cares if it's number 1 on the list? Just avoid Newark, New Jersey. There's a lot of reasons not to even drive through New Jersey.
A lot of reasons to avoid Newark, folks.
Right.
But here's the bottom line, and I think this is kind of the point they were trying to make today is that, hey, for California investors, you do have an option. You do not have to be stuck.
No.
Even if you made a great investment in some California real estate, you're not stuck in it. You're not stuck with 5% cap rates. You're not stuck with 6% cap rates. You can get 9, 10+% cap rates elsewhere, and 1031 your money out of the state of California. There are a couple other things. Number 1, rates down, which is makes it a really good time to sell because you have to sell before you can 1031. And you also have some of the things that are going on here in the state of California. The last 2 years, we've had a little bit of an exodus going on. There's been a lot of people leaving. There's some things kind of lining up that are looking weird. Taxes are still going up, but wages aren't. And the prices are still going up, but wages aren't.
Right.
So a few things that could cause problems. You know, they could cause problems for real estate value. So if you have a huge run and a huge profit on your hands, and you could take and turn it around and go get 8 or 9%, I think you really have to take a look at that.
I agree.
I'm just saying.
Right. I mean,
you really should take a look at it. I mean, that's the whole point. That's why we brought Scott here. I mean, what he's doing in Indianapolis is exactly what I've been telling people who have been investing in California real estate. Man, gosh, you're taking a lot of risk. You know, it's the reason I've personally never invested in California real estate as an investor because I just look at it and go, gosh, I don't like my risk reward. I just feel like I'm flapping in the wind. Like it needs to go up so much in order for me to cover my cost of sale.
Now, here's
and
the
all
interesting
those
part is that what a lot of investors sometimes don't realize that they're all in real estate, but you also have the ability that you can 1031 out of your IRA. So let's say you've got a big fat, again, the market's gone up for 10, 11 years, and you've got a big fat IRA, and you're like, yeah, but I don't have skills to manage that well, and so I'm nervous about it happening again. And so it might not be your portfolio might not be all in real estate, but you do have the opportunity to actually 1031 out of that as well.
Interesting.
Right. So that's just something that most people don't know that they can do.
So if you bought the real estate with your IRA, you can 1031 it out.
Right. So you can actually sell in your IRA, and those gains you can actually 1031 over into property.
And tell me about the empowerment zones again.
Oh, the empowerment zones. Yeah. So the empowerment zones, this is a new thing, and it's but in a lot of cities you have zones to where there's a high incentive for investors, real estate investors, to come in and invest. And so what they've done is that they've given a scale that you come in, and the longer you own a property there, that when you sell it, that they'll give you breaks from 15% up to where you can get out with no capital gains.
No capital gains.
No capital gains.
What?
So yeah, it's 10 years or more.
We have to do a whole segment around this.
Yeah, I think this. But again, it's one of those things is that if you're going to do it and go out of state, you got to be really careful of where you do it. So someone, like I just got done selling one in Indianapolis, and I had held for 10 years. So it was, yeah, it was nice.
In an empowerment zone?
Yeah.
So you paid no capital gains. Hold on. So you bought a house, rented it out for 10 years for the cash flow.
Right.
And then when you sold, you depreciated it.
Of course.
The entire time.
Yeah.
And then when you sold it, you don't have to pay any capital gains tax?
Right. Because I had my account, I sent the links, everything, and I get it back from both, from the attorney that closed of my title company back in Indy, and everyone was like, "Yep, you're right. Yep, you're right." And so that's as a new thing is that if you're going to do that, it has to be done right, because again, you just if you buy in an empowerment zone, you know you're buying in a neighborhood where they want the investment coming in, so it's going to be rougher. So you're talking now, you're getting into C minus type properties, or even worse. And so to find the edges and to do that properly, again, if you want that, you've got to have someone with boots on the ground that really knows the neighborhoods and knows exactly where to do that.
It's funny because I was just looking when we were back in St. Louis. We were driving through this area, and there's this really, really bad area that's right next to this really nice area. And so I said, Dad, why don't we loop back around? And we loop back around and said, where is the line drawn here?
Right.
Because you really want to buy just the first bad house.
Right.
And that's such a big difference than buying one 2 blocks that way towards the bad side.
Right.
Just buy the first bad house.
Yeah.
You
What
know?
do they say? You buy the worst house in the best neighborhood.
Right.
Okay, well, this isn't quite the same thing. So
It's the same concept.
Right, exactly.
It just makes sense.
Right.
Well, this is great stuff. So you can check out April 25th at 5 p.m. We'll put the link below if you'd like to come check out the event, hear Scott speak, and learn more about 1031 exchanging. Or if you'd like to learn more about passive real estate investing for income, you can also do that at the link below. Scott, thank you so much for coming in today.
Got it, man.
Great to see you, brother.
Pleasure.
Appreciate your time. Share this video. Make your friends smarter than everyone else. We'll see you soon. Thank you very much. Investing for income, you can also do that at the link below. Scott, thank you so much for coming in today.
Got it, man.
Great to see you, brother.
Pleasure.
Appreciate your time. Share this video. Make your friends smarter than everyone else. We'll see you soon. Thank you very much.